Let's have a look at the slow stochastic today. I'm facing a little bit of problem with my audio. I'm getting a lot of echo here, so it's a little inconvenient for me. But let's just go right ahead. Well, first and foremost, indicators. Right? One thing, let me just start with and repeat it again, which I have said earlier, is always use the indicators in a secondary role. No, I mean a primary way. All indicators are lagging. Generally, if you look at the calculation of any indicator, you'll see that it depends on price. So if you look at the calculation, you have the value N generally in an indicator. So price changes first, which causes the indicator to change directions, or it generally follows price. So if you have the indicator following price, why would you expect the indicator to give you an leading indication of an expected price movement? So indicators must be used in a correct way. The first thing is never use any indicator for your trading parameters. The simple fact is that if you choose to enter a trade based on, let's say, a stochastic line crossover, or moving average crossover, MACD signal line crossover, you're going to be in trouble because it's lagging, and by the time you get into the trade has already gone about halfway through. So you are part of the crowd. As soon as you enter, price starts changing. And if you go long, price has already gone ahead, and the minute you enter, it starts going down. This is normally the thing which I have seen with a lot of traders. So entering a trade should always be based on price action. It could be simple levels of support, resistance, trend line breaks, Fibonacci levels, pivot levels, could be anything. But do not use an indicator to set the entry level or the stop level or even a target level of a particular trade. Right now, using indicators in a secondary role, one can use indicators in a primary role so long as you understand how the indicators work. For example, we had a look at the RSI earlier. The two examples, let me just go over. The RSI, we saw that if you use it in a regular oversold, overbought situation, you're not really getting the correct picture. So all the traders who are using the RSI as an oversold, overbought will probably get than half of your trades wrong. It was a simple fact. We saw that an RSI is best used to determine the breakout of price. When price is range bound and starts moving out, the RSI is the best indicator to tell you whether that particular breakout is a genuine breakout or it's a false breakout. Has the momentum really picked up on the correct direction? And we also looked at one particular way to plot trend lines on the RSI so that it gives you an earlier indication. Similarly, we had a look at the Bollinger Bands, saying that when the Bollinger Bands tend to squeeze together, you can expect a volatile move. Right, now let's have a look at the slow stochastic. Now the slow stochastic is an oscillator. So any indicator which is banded between a value of 0 to 100 is an oscillator. Like the stochastic, the RSI, the MACD, the CCI, the momentums, they are all oscillators. The simple fact is that oscillators do not work or are ineffective when price is in a trend. They work very effectively only when price is range bound. Let's have a look at this particular situation. Now, I would definitely classify this as a range bound price. Right? The price is between a value of a resistance and a support, just bouncing between the two. Now, this is the place where your stochastic or any oscillator would be quite effective. The stochastic becomes particularly effective because of its calculation. It gives you the oversold, overbought levels very clearly when price is in a range. So if you look at this and your stochastic now price is moving in one particular tight range, and a stochastic goes oversold, this would be a good place to probably buy with an expected target, let's say, to the high of the zone. So in a way, it's quite good. But once again, like every indicator, it does become lagging. Now, one of the characteristics of the stochastic is when price is in a trend, we've seen that, or we know that price is, or the stochastic, any oscillator is not really effective. Now, let's just have a look at this particular downtrend. We have price moving in a pretty strong downtrend, as you can see over here. Now, if you use the stochastic like any oversold, overbought situation, and price moves down, your stochastic goes oversold. If this is a place where you would tend to buy at the crossover of a signal line, you would probably be in trouble because the indicator tends to remain in the oversold, overbought region for a longer time when price is in a trend. As you can see, I have highlighted it over here. So it tends to give you false signals. Now, one of the places where the stochastic, specifically, not the MACD, not the RSI also to a certain extent, but the stochastic can give you an indication of whether the trend is continuing or it's not. Right? Now, let's trade the hard right edge of the chart. Supposing you are here. Now, at this particular situation, let me just put this back here. One would probably look at this strong pullback, right? This particular strong pullback. And one would think that price has probably changed trend to the upside. It's a pretty strong. Now, general thumb rules a lot of traders look at is in this existing downtrend, you have this pullback, which is a pretty small one. You have this pullback, which is a pretty regular pullback. And if you have a look at this pullback, it certainly is a very strong pullback, which most of the traders tend to take as an expected change of trend. So they would want to go long over here. First of all, they would probably enter at the crossover of this, go long somewhere here when price is crossed over and moves. And you tend to go long, you have some good profits coming in. What happens? Price keeps continuing towards the downside.